not a financial advisor, so don't pay attention to anything I say in this video. I don't know what I'm talking about, so disregard this video at all. And if you want, skip this video. Anyways, I want to talk about what I've learned over the past couple of years with subjects such as day trading, swing trading, and long-term investments, and at least my viewpoint of it all after being a couple of years in the markets and seeing how things work, right? So from a macro point of view, I have noticed and I have seen, and you can view it in the charts as well if you take a look at them. The whatever the Federal Reserve, whenever the Fed raises rates, stocks crash, right? And whenever they lower rates, stocks rally. And this has to do with the debt that companies have and what it costs to service that not just companies but individuals as well, and businesses and so on. Higher rates mean less money for individuals, less money for companies and corporations, right? Lower rates make things easier for the consumer and companies and so on. So it makes sense, right? It makes sense that when they raise rates, things get tougher, and when they lower rates, things get easier. It's cheaper money, right? On the flip side, well, if rates are kept too low for too long, then it causes inflation eventually, right? So a reason as to why they raise rates is to battle inflation, right? So there's three ways to play the market. You can do day trading, which is buying and selling the same day. You can do swing trading, which is buying and holding for more than a day, a couple weeks, a couple months. That's swing trading, right? And then you sell and take a profit. And long-term investments, buy and hold, right? Long-term. So when it comes to long-term investments, the thing that makes most sense to me would be dividends, right? Making money through dividends. Warren Buffett has talked about that his whole life, and it just makes sense, right? Compounding interest, right? When it comes to swing trading, well, I think it's circumstantial, and it's very dependent on interest rates. So if the Fed is raising rates and you're planning on holding something for a few weeks or few months, it's pretty dangerous, right? Because you know that raising rates causes downward pressure on stocks. So it's not a winning bet, right? Especially after the market has rallied, which happened for many years at least, since 2009 till 2020, 2021, 2022. The markets were in a very, very strong bull market, right? So so the pullback was bound to happen, and it is happening. It has happened at least all of 2022. We'll see what happens in 2023. But the Fed, I don't think they've backed down, or I don't think they're planning on backing down with raising rates. Inflation is still high. I believe it's at 7.1% now. It has been going down. It was at 9%. 7% is way too high still, right? But we'll see. I think the Fed is overextending. I think they're gonna overdo this rate thing, because If inflation is going down, stocks are going down, gas prices have gone down. If they push too hard with those interest rate increases, then it might cause the opposite effect, which is inflation, which is what they don't want, right? And they're just trying to raise rates to lower inflation to the official 2% inflation target that they always like, right? So we'll see what happens in regards to that. So, anyways, in a downward market or in a choppy market or in a market where Feds raises rates, I believe day trading would be the most appropriate thing, buying and selling the same day to reduce risk. And long-term investment would be with dividends, right? Would be the most appropriate thing, I believe, as well. Swing trading, risky. Um, on the flip side, when the market is rallying, swing trading to me makes a lot of sense. So it's circumstantial, of course. One would have to learn shorting as well, obviously, placing long trades, placing short trades that would make the most sense on the long term on an individual level. I mean, you have to learn both sides because the market is not always going to be bearish and it's not always going to be bullish. So you need to understand how to place trades on both sides and profit from it. But not only that, of course, you would have to diversify whatever profits you make out of the market, right? Because there's only so much there's only so much you can learn, and time is limited. You can't learn everything about the market. So, the way I view it is if you make a profit, then you diversify it outside of the market into other things, other assets, other income producing assets. That's the way I see it. Um, I mean, with the markets, of course, anything can happen, right? Same with business, same with everything in life, right? Everything is unpredictable. You can control risk, but there is always risk at whatever you do, right? Um, that's just a fact. It's a fact of life. We just have to deal with it, try to reduce our risk as best as we can, and hope for the best, right? Plan for the worst, hope for the best is what they say. So yeah. Um, that's my viewpoint with these subjects. Um, when it comes to swing trading, what I have learned is higher lows, higher highs. That's how you can get into a winning trade, right? So you want to buy something after it has consolidated, after it has formed a base, after after volatility has calmed down, and then a stock starts uh, achieving higher lows, higher highs. That's how you can get into a winning trade. That, of course, is swing trading, which would be different from the other things I mentioned. When it comes to dividend investing, due to the long-term target of 2% from the Fed, my viewpoint is it would be best to own stocks that pay higher than that on the dividend, right? 2.5, 3% or more per year on dividends makes the most sense to me. You would be beating the inflation target that the Fed um, aims for, right? Um, at least on the most minimal scale. Of course, Stocks can go up or down. You don't know what they're going to do, right? At any given moment. But at least on that number, you would at least be beating the inflation target set by the Fed, right? One thing I've looked at is the dividend aristocrats and dividend kings, which are companies that have paid dividends for the past 25 or 50 years, right? Or more. This makes the most sense to me when it comes to dividend investing because the thing about dividends is it can be a tricky thing or it can be an illusion, right? You can have a company that's paying dividends today and then tomorrow they just cut them completely. So you're left holding the bag basically. So it's to go furthest away from that quote unquote illusion would be placing trades in companies that have paid dividends for many years, right? And or are in the dividend aristocrats list. That would just make it more likely for you to get a guaranteed dividend. But the fact that they can lower their dividends, well, that's just a risk, uh, unfortunate risk that happens. Um, but everything has a risk, of course, right? But that's my viewpoint on the markets. You should always, at least my point of view, you should always diversify outside of the markets, right? Have some type of side business, side hustle, or um, real estate, or and so on. Something tangible, not just the markets. Over the past few years, the way I have viewed the market is just as a tool that you should use, that you should utilize in order to obtain more wealth. That's the way I see it, right? But anyways, make sure you like, share, comment, subscribe, watch my other videos, and like I mentioned, I'm not a financial advisor. Don't listen to anything I say. I don't know anything about what I'm talking about when it comes to finances. All right? You have a good one.